So we move to chapter 8, cost classification. You'll see that we've split this particular chapter into several parts because there's quite a lot of it. In terms of this particular area in the MA exam, certainly understanding the idea of separating costs into different types is important. And this first section sort of leads into that, the area of responsibility accounting. Because at the end of the day, these responsibility centers, as we'll see, will distinguish between control over costs and indeed control over different types of costs. Let me explain what I mean more thoroughly. We're talking about the idea of cost units and indeed cost units related to centers. Now, what do we mean by a cost unit? Well, first thing is, we're really talking about something that can be associated with a particular product or indeed a service. So an example might be, let's say, a microchip manufacturer, a unit of microchip that can be associated with different costs. In essence, let's note that a cost unit is not always going to be a single item. It could be, calculated in batches. There could be a number of different things that make up a particular cost unit. And getting back to my point about the use of this particular area, really an understanding of costs and indeed the resources required to produce cost units helps managers make decisions. What decisions? Well, for example, setting a selling price. Outside of that, controlling costs. Moving from there, when we think about cost units, we should also be thinking about cost objects. In other words, the idea that we have a range of different cost units making up something. So for example, let's say nails, or a service of some kind, e.g. hair cutting, or perhaps an object that manufactures or provides support services for a particular product or service. Or maybe even a cost object might be a department, i.e. the production department. So let's distinguish between units and indeed objects. Outside of that, getting back to the point about responsibility, really, we need to understand what we mean by responsibility accounting. And really what we're talking about there is the idea that when we consider, let's say, a manufacturing business, and indeed a manager, or indeed a department, we need to be able to associate or indeed account for costs according to the manager's responsibility for those costs. So really, responsibility accounting means, okay, we have 5 different managers. What are they actually responsible for in terms of costs? So given that, we'll have different types of responsibility center. Now, there may be a focus on costs, there may be a focus on profit, there may be a focus on revenues or perhaps investments. So let's note that there are several different types of responsibility centers, and really all they are is an area or an activity where we could sort of link a manager's responsibility. Now, given that, a very, very important concept within MA, and indeed you'll see this referenced in other parts of the ACCA qualification, is this area of a controllable cost versus an uncontrollable cost. Now, this is important because think about it. When we think of managers, we think about appraisals. We think about assessing a manager based on their performance over the course of time. So in essence, what we should be doing, and a key theme, is only assess a manager on a cost that's within their control, and certainly do not assess managers on costs that are outside of their control. Now, that may seem like a very, very simple concept, but you're going to see it quite a lot in your qualification. So let's make sure we understand it. So a clear distinction then between controllable and indeed uncontrollable or non-controllable costs. So we talked about cost units, we talked about cost objects, and now we've moved on to cost centers. Now this is the first, if you will, basic type of responsibility center. What do we mean by a cost center? Well, really, an area of responsibility or an activity where the organization generates costs and indeed the manager overseeing that particular area or activity is not responsible for generating revenue or producing direct profit, just responsible for the costs. So what might be an example of that? Well, let's say a particular function. Some organizations, in fact many organizations, would treat particular functions, production, IT, etc., as just cost centers. In other words, they're only interested in assessing or appraising that center based on its costs. Perhaps another way of looking at it is a process of some kind. For example, let's say a finishing process in a bespoke furniture manufacturer. So in essence, when we think about cost centers, we're just thinking about an activity or an area of responsibility that really we have a manager who's solely responsible for the costs that are generated under their control, not responsible for revenue or indeed producing direct profit. Let's move from there to a revenue center. Now, this very much does what it says in the tin. We're saying a department or a division where revenues are collected. So in essence, the manager of a specific revenue center will be responsible for the revenue of their center, note, not the costs or the revenue of anything else. So that's a revenue center. So two so far: cost center, costs only; revenue center, revenue only. Where do we move from there? Well, we move into a profit center. Now, as you would expect, a profit center is really, again, activity or area where the relevant manager is responsible for costs and revenues. So we can directly attribute it, costs and revenues, to that particular activity or that particular area of responsibility. An example, might be, let's say, an individual health club in a chain of clubs owned by a company. Let's say a salesperson, or even a restaurant in a large hotel responsible for driving throughput in terms of customers and also the costs associated with that. So outside of the definition, what would be the key features of a profit center? Because certainly it sounds more highbrow, sounds more sort of high level. Well, first things first, most likely some level of organizational hierarchy. In other words, where you have profit centers, let's say it's a restaurant and a hotel, generally speaking, you would expect them to sit higher than cost centers. And indeed, there are often several different cost centers within a given profit center. Outside of that, when we think about managers, or indeed the seniority of profit center managers, it's highly likely that profit centers cover a significant area of operations because obviously they're profit driven. So it could be, an entire division, let's say, or in part, a large part of an organization. Outside of that, third key point is external and internal revenue. Generally speaking, you will find that, a lot of profit centers can generate revenue externally, obviously, but also internally, perhaps by selling to other parts of the organization. So let's not just presume that a profit center would be customer facing, i.e. external customer facing only. They could be supplying different parts of the business. Fourth and final point, from cost center to profit center. Now, what we mean by that, it is possible for a cost center to become a profit center. So, for example, if the delivery driver becomes the general courier service used by other organizations, or perhaps, for example, if an internal service function starts charging for the services that it provides, okay? But for me, the first 3 points are probably the most important. Let's move from there to the investment center. So far, we've discussed cost center, costs only; revenue center, revenue only; profit center, both, i.e. costs and revenues. Now we've got to the big boy, as it were, an investment center. What do we mean by that? Well, basically, again, activity or area of responsibility where Costs and revenues can be attributed, and capital deployment. Now, what do we mean by that? Well, we mean investment decisions. In other words, decisions with regard to, oh, let's buy some new equipment. So, in essence, when we think about an investment center, it sort of sits on the top of the tree, doesn't it? This is just about everything. The manager of this particular investment center is responsible for all the costs, all the revenues, and therefore the profit. But on top of that, for making capital decisions, let's invest in this truck, let's invest in this building, etc., etc. And indeed, linked to that, because investment centers will generally be a business unit, in other words, a significant business unit. In essence, we're talking about all three: cost, revenues, and asset investment. What do we mean by business unit? Well, again, a high degree of autonomy or independence in terms of deciding plans and processes for generating profit. So we're talking most likely of a large division, a large element, perhaps a subsidiary of a business, maybe a foreign subsidiary. So there's the four key areas of responsibility centers. Now, in terms of structure, bringing it into a sort of a diagram, as it were, as you'll see here, down the bottom, cost and revenue centers. Moving slightly up, profit centers. And indeed, right at the top, as mentioned, an investment center. Now, any given business could have each of the four of these. They could have a number of them, no problem at all. Let's be careful about the definitions and being able to distinguish between each of these four types. Examiners, the AMA examiner included, likes this area. Let's be ready for the questions. Now, we touched on, within the investment center, expenditure, and indeed capital expenditure. What do we mean by that? Well, asset expenditure, we're really talking about when a new non-current asset, doesn't necessarily have to be new, is bought, or an existing non-current asset are improved in some way. So we're talking about adding to our equipment range, buying new vehicles, buying new trucks, possibly a building. That's asset expenditure. Now, albeit for the fact that double entry isn't overly important within the AMA exam, let's just be clear on the double entry. In terms of buying in assets, we would debit the asset, i.e. increase assets, and we would credit cash, or let's say payables. Now, in essence, what we're talking about there is our double entry rule. How do we acquire an asset either for cash or indeed on credit? We simply increase assets, debit, and indeed we reduce the asset of cash bank or indeed liabilities, increase liabilities, to allow for the other side of the double entry. I wouldn't worry overly about double entry within the MA exam, okay? So that's asset expenditure. What about expenses? I mean, obviously expenses are relevant. What do we mean by expenses? Well, just ongoing costs of running the organization. Certainly expenses are expensed. What do we mean by that? Well, we basically match them to the current period. Expenses might include, for example, raw materials, paying for labor, paying for rent. These are standard day-to-day, week-to-week, month-to-month expenses incurred by businesses. What about the double entry? Double entry is simple enough. Debit the expense to increase it and credit bank or cash, or indeed payables, i.e. liabilities. So in essence, what you're doing is you're charging to the profit and loss account as an expense, as you would expect, and indeed you're either reducing the asset of cash bank or you're increasing liabilities. Okay, so let's move from there to the classification. Now, note that there's a difference, obviously, between expending cash on expenses and expending cash on assets, because bottom line is expenses are tax deductible. You can deduct them from your revenues for the given period, thus reducing profit. But obviously, asset expenditure, buying a truck, buying another piece of machinery, certainly doesn't affect the calculation of profit, notwithstanding the fact that obviously our depreciation will increase. Moving from there, really, we're going to move in now to our second part. We have three main parts to cost classification, and in part two, what I'm going to be talking about is really sort of distinguishing between different types of cost. A simple example might be, let's say, the difference between a fixed cost, which is static over a given period, or indeed maybe a variable cost, which varies with production. Okay, so I hope that part one made sense, and that you're enjoying the course and that you're working hard. Many thanks for listening to me. Please do join for part two.